Time now for Options Corner. Joining us to take a deeper look at this chart is Rick Ducat, lead market technician. All right, Rick, Cisco up more than 20% year to date. What trends do you notice in this chart?
Yeah, Cisco doing pretty well versus the broader market, but actually lagging a little bit behind the broader tech sector ETF, 22% versus 24% respectively. If we were to look at other companies in this, kind of networking hardware space, Cisco is near the top versus the likes of Arista Net, which is outperforming, or Palo Alto, HP Enterprise, or Fortinet. So those are some of the players in this networking space that is becoming increasingly important for data centers and other areas like that. So when we look more specifically at Cisco's chart, we can see that there was a clear breakout point here around 66, these old highs that we established around that general area. We touched there once more, broke out to the upside, retested it as a supportive area, and then moved on to the upside. We also crossed above a similar high point here. We saw the 7250 level. That was about where we had some chop. We pushed out to the upside. 7484 was the high point from this chart here. But now we've retreated. So in the shorter term, we have our lows, 7054, our recent highs, lining up with these old highs here near about 7250. So about a $2 range roughly is where many traders might have their eyes on for today's session. When we look at our moving averages, we are hanging on to our yellow 21-day exponential moving average right here near 7120. It lines up pretty closely with our short-term upward sloping trend line here, giving us our white channel boundaries that you can draw around much of the price activity there. RSI has dropped off after a very brief push into that overbought area. So that one did not materialize here, but we are still above the 50 midline. We are still in bullish territory here. So when we also look at our volume profile and standard deviation channel studies, our closest volume node here lines up with our linear regression line, our line of best fit, giving us this supportive area near 7050 once again. Our point of control a little bit below around 6832. Finally, if we were to look at the expected move for December's monthly expiration, about 8.7%, please excuse that, it should say December, but up here we can see that we have our breakout point near about 7250, the top of our range around 78. So those could be some boundaries to keep an eye on going forward.
Please excuse that. It's excused, Rick. I'm just teasing you. That's Rick Ducat, the Duke of Data himself. Now to take us through an example trade is Tom White, senior options contributor and co-host of Fast Market. So Tom, what's the approach you would take for an example trade given earnings are in front of us?
Yeah, the bar's kind of high here, Diane, going into this report. Stock's just below those highs that we haven't seen since the year 2000. So we're at or near 25-year highs in the stock. And you've seen that growth, the networking side of their business. That's supposed to grow about nearly 9%. That's slower than what we saw last quarter of about 12% year over year. But cybersecurity segment is supposed to grow about 11%. So expectations really elevated in this name. So I looked at a strategy that doesn't really take advantage of the earnings event, or it kind of avoids some of that volatility that we might see in the near term. I put a little bit more duration in this option strategy. Went out to the December monthly option series, so about 37 days to expiration. And we're going to buy a directional call vertical. It's an inexpensive way to take a directional bias on a stock like Cisco. And for this example, I'm going to use the bullish side. So if you think the stock's going to go higher post earnings or over the next month, this strategy takes advantage of it. So we went out to that December monthly cycle, just over a month to expiration. Buy the basically at the money 72.5 strike call. Stock's going to open up here just above 72. And then against it, to offset some of the costs on that bullish call purchase, we're going to sell the 80 strike call. So a bullish $7.50 wide call vertical to the upside. You're going to pay roughly about a $2.25 debit if the stock opens up here just above 72. So that's the risk on this position, $225 per spread. That can expand to $7.50 if it gets above the 80 level over the next 37 days. Now, if I pay $225 debit, where do I need the stock to go? Well, I need to go above my break even, 74.75. That's just over 3% above the current share price. The option market pricing in about a plus or minus $4 move in the shares, about 5.5%. So That break even's well within that 1 standard deviation move. But I think the key here is if you're doing something near term that might have shorter duration, maybe you're going to pay $2 for the same strikes on a call vertical. But I went out a month and I'm only paying 25 cents more for that. So I'm giving myself duration on this for the same directional bias. And this gives me some flexibility as far as trade management. I can close this ahead of time. I don't have to wait the full 37 days if I get the move necessary to close it at a higher price.
All right, thank you, Tom, for that example trade there for Cisco. Those earnings due after the bell. Appreciate that.